Erin, Alex, today we're going to talk about long-term insurance. It can be highly technical, very complex, and a minefield for somebody to try and navigate alone. But for most of us, it's actually quite important to have in our portfolio. Erin, a lot of our clients come to us and they've got group life cover in place, and they assume that that is enough for their needs. Is this always the case? How dangerous is it for clients to assume that their group risk cover is actually sufficient?
It's great when we see clients with group risk cover because it means the employers care about them. The problem that we face is the cover tends to be placed on a very broad aspect. So you'll see clients with a bland 3 times annual salary. So when you're dealing with someone who's really young, they probably do not need 3 times their annual salary in life cover, whereas somebody who has a family and a full bond, this might not be adequate. So I think the danger of assuming that you've just got cover through your employer is that it's actually not tailored to your specific needs, and you might just be either over or underinsured. The other nice aspect of having group cover is that it tends to be more cost effective. So if we have a client that comes in and let's say they've got group cover and they've got personal cover, a lot of clients don't want to let it go of their personal cover either. So we need to look at both of those, and we start with, what is your group cover? What benefits does it cover? It's generally more cost effective and has favorable underwriting because they look at the group as a whole. Whereas in your personal capacity, you might have exclusions, as an example, on your cover. Another important aspect to consider is that if you have 2 income protection benefits, so let's say your employer offers income protection and you have it in your personal capacity, often the insurers will aggregate. So they'll look at both benefits and they'll only pay you the maximum of your net of tax salary. So you could have too much cover that you actually can't claim from. So it's really important to assess what you have with your employer, understand what those benefits are and what they provide, and then look to top that up with your personal cover.
So not to look at either in isolation. They need to be looked together to see that in whole, you are adequately covered in all those different areas of risk. Then when it comes to group life cover, the terminology that gets thrown around is approved and unapproved benefits. Can you just elaborate for us?
So when I first started studying, I used to always get confused between approved and unapproved. And in my mind, how I used to think about this is, if it's approved, SARS is going to tax you. It's approved by SARS. So basically what happens is approved cover is owned by the retirement fund, and it pays out to your retirement fund and is lumped together with your retirement benefits. So what happens is that it's now regulated by the Pension Funds Act, and when it pays out to you, it will, if your beneficiaries take a lump sum, it will be subject to the retirement death tax tables. Whereas unapproved cover is owned by the employer, and when it pays out, it will not be subject to tax.
So Erin, it's important for people to understand if they have unapproved or approved benefits in place so that they can actually plan accordingly.